The information flow is endless, and with so many sensational headlines, changing policies, and market fluctuations, it can be tough to keep up with what's most relevant to you as a real estate investor. In Boardroom Brief, we endeavor to discuss and provide our point of view and insights on relevant topics that matter to Greybrook, our investors, and the broader real estate community. Our goal is to provide you with expert opinions in 20 minutes or less.
Sasha, welcome back. Another episode of Boardroom Brief. I appreciate you being here.
I appreciate being here. It seems like a long time, but today, every minute seems like a...
Totally.
Yeah.
It's wild because, we're wrapping up the end of Q1, and it does seem like a long time, but here we are, almost at the end here of the first quarter. And as we follow the news cycle, it's, the theme of the news cycle seems to be uncertainty. And, I kind of joke around at home that the only thing more uncertain is my daughter at a Baskin-Robbins counter right now. But there's a lot of things. I think there's a lot of things we got to pay attention to. And when I think about Greybrook, one of the things we do well is adapt. So I wanted to talk about that today. When it comes to what's happening right now, and we spoke about this last time with tariffs, for example, are we making adjustments to some of our cost inputs? Are we adapting to what we think is coming?
Yeah. Okay. So let me try to answer that question two ways. I think there's a certain element of the world is handed to you because professing to have a crystal ball such that you can make concrete decisions in every respect is just a fool's errand. I think.
Sure. Yeah.
I think there's just a lot of stuff going on right now, and part of it is kind of digesting it as we go. And to your point about adaptability, one thing we've always prided ourselves on is how actively involved in all of our projects we are.
Sure.
So we're not a passive investor, we're a very active participant. And to be an effective active participant, forget this time, like any time, you have to really know what you're talking about. You have to be in the flow of information. You have to be, we always talk about the fact that given how many portfolio projects we have, we're always in the market doing something.
Yeah.
We're either buying something, selling something, financing something, tendering construction for something else, and you're almost constantly and you have to harness that information, and it helps you make decisions, right? Data is key in our industry as it is in every industry. The thing that you do have more control over are new acquisitions because you haven't acquired them yet. So you can create any set of assumptions today, and you also have the option to do nothing. Mm-hmm. So we look at the uncertainty that exists and a little bit of what we believe might happen in the future, and we look at our current acquisitions, and what we're focusing on is two things primarily. Staying within the thesis of the things that we buy, which really hasn't changed materially. It's all about how you buy them. So the focus has become, the price point that offers the most level of flexibility. So the best example of the best way to illustrate that is we're only willing to pay a price that will still work the way the world looks today. And if things get materially worse, we should still have some flexibility built into both our acquisition based on the price that we paid, as well as the structure that we choose. So if we're buying something, for example, like our last high-rise site where we bought at under $60 a buildable foot, we felt that was an exceptional entry point based on where the market has been, based on where we believe it'll go.
Sure.
And we also acquired it with no debt on it. So that gives us the ultimate level of flexibility should things change, should things take longer to kind of sort themselves through. So that's really where our focus is on new acquisitions, because we can control what we buy, how much we pay, and how much leverage we're willing to use. As it relates, as I said, to the existing portfolio, sort of stage dependent. And then the rest, I think forecasting is, we do it, it's required, but more importantly than the forecast is having the capability to pivot, having the capability to make real-time decisions quickly. And to do that well, you need to be so on top of the information, so on top of the analytics, and that's where we're focusing.
Okay, so one of the segments that continues to sort of experience some continued uncertainty is the high-rise segment. And one of the ways that some developers may be adapting is to start to cater some of these units to end users versus the investor buyer who has traditionally absorbed so much of that inventory. Is Greybrook making some of those changes to some of the sites we currently own?
The sites we currently own, I would say, in some cases, like it sort of depends on area. That's one of the things. Two is kind of what our approvals already entail. Historically, as you know, and I think for our viewers, it'd be important to kind of make the distinction. The investors are a hugely important component of the high-rise market, because in pre-construction, if you just think about on a simple level, people aren't making usually their life decisions in kind of 5-year out increments, right? It's the case of, hey, I'm going to buy this because 5 years from now I want to live here. It happens, of course, and there's cases of that, but by and large, it's investors that are performing that very important function of helping buildings get built, and it's critical for our condo supply. It's critical for our apartment supply,
Sure,
our rental supply. Having said that, I think for investors to feel confident and get back in the market and sort of, get the pre-construction segment flowing again, there needs to be end users that come to the market first. And I think that's going to happen less by way of developers reconfiguring existing projects to sell to end users, because I just think that buyer pool is a lot thinner. And I think it's more going to come from the inventory of units that are being delivered that investors have purchased, that often those investors, if they're not renting them out, they're going to want to sell those units. And historically, an offtake has always been end users, right? People that want to buy and move in 3 months. And I think right now the gating item to more end users, so you're probably reading in the paper that there's this standoff between like all these listed inventory units and no buyers. I don't think that's for lack of demand. I think that's because the gating item as it stands today is still people that purchased at a certain price would like to liquidate at that price or near that price. And at the same time, interest rates where they are at, combined with the uncertainty that people feel today, and a generally gummed up resale market is contributing to that lack of overlap between a buyer and a seller. I think once interest rates start to continue to come down, which they will, there's some noise around that because there's a lot of geopolitical uncertainty, a lot of economic uncertainty, but certainly none of it is leading us to conclude that interest rates should go back up, right? It's only a question of how far and over what time do they come further down. I think once that gating item continues to sort of work itself back into a long-term average kind of position, and if some of the economic uncertainty becomes a little clearer, I think end users are going to return to the market. And I think that once they return and clear some of that inventory, the confidence of the pre-construction buyer is going to start to change.
Sure.
Part of it is just the confidence of having seen a market bottom and people tangibly seeing, oh, demand does exist. I think we all know it. I think when they start seeing it, I think that's one thing. The news cycle will certainly help that. The second part of it, I think, is when the math starts to make more sense, right? Like once you've sort of seen the market clear at a certain level, and then all of a sudden that price starts to show forward growth again, rents start to creep up again because they've been flat for about the better part of a year. I think that math starts to make sense again for investors, and then the pre-construction market can kind of start to resume. As it relates to people like us who need to prepare ourselves for that, what we're doing is we're trying to create the most marketable type of inventory, right? So I would say that we haven't changed our perspective as to who the ultimate buyer is. We still believe it's an investor buyer. You're just trying to create the exact right package for that investor buyer. So what are they looking for now? Not a lot of people want parking. They want certain suite configurations that are more popular in the rental pool. So we're trying to reconfigure buildings to fit that sweet spot more so than saying, you know what, we think it's going to be a bunch of end users, so now we're going to add 2 parking spots to every single condo unit and make them really big. Because historically that has never been the case. And if you just think about human behavior and how people make purchase decisions, we see enough of it, right? We see enough of it in high rise. We have a big low rise portfolio, as you know, and that's where we see a lot of end users because the time to delivery is very different than it is in a high rise. So we haven't shifted our focus. We're just tweaking the type of inventory to fit better for when that buyer's back in the market.
Very interesting. And one of the things I frequently talk to investors and associates about is, the cost to construct, the cost to actually erect housing, especially in high rise, doesn't seem to be getting any cheaper, right? Like the actual cost stack continues to rise.
Yeah.
And one of the major inputs to that cost stack happens to be development charges, municipalities, various levels of government. Recently, we've seen a couple of municipalities call out the fact that they're going to make some significant changes to their cost stack to try to encourage developers like the Greybrooks of the world to sort of come back into the municipality, Vaughan, Mississauga being the two major ones. Does that sort of make Greybrook, relook at the radar and say, okay, we need to really circle those municipalities now because it is such a material incentive?
I would say it is a material incentive. I think we've always been very focused for high rise. If we're talking about high rise specifically, we've been specifically focused on the 416 with a couple of exceptions. And I think that the reason is that we've always felt the epicenter of our market here in Southern Ontario to be the most resilient and, should rebound quickest. And, like real estate is always about location and quality of location. And I think throughout history in different countries, the epicenter of cities has always remained the most resilient. So I think we've always focused on that. Development charges have been a big component of cost, right? So as you pointed out, I think, somewhere in the order of magnitude of just take the last 5 years since the pandemic, of any line item that has changed in the pro forma of a developer, development charges has been probably the most exponential growth.
Yeah.
So it's been a big cost. I don't always know why. I mean, I know the reasoning behind development charges and funding the infrastructure and things like that, but sometimes I think it's been oversimplified. Like people look at the revenue line and saying, well, it sold at $1,000 a foot, now you're selling at $1,500 a foot, therefore I can increase my development charges proportionally. Not paying a lot of attention to the fact that other input costs have also changed, and as a result of that, all of it together impacts affordability, which frankly should be the primary concern of municipalities. So I do think that the changes that some municipalities are making are really critical. Is it going to change where we invest in high rise? I don't think it will. But I will say that, while it's the most exponentially growing line item, it's certainly not the only line item that's changed. And I think what we're going to see as this market recalibrates itself is a combination of both price rebounding, but also some of those input costs falling into better line. Will the city of Toronto, follow suit with similar cuts to development charges? I don't think so. But there are other things. Like, for example, there are sites where parking, we talked about parking a minute ago, where parking requirements were high. All of a sudden, parking requirements have been drastically dropped. Density has been something that has been a bit of a less contentious topic of discussion, where before maybe you could get 15 stories, now you can get 20 stories. So there are other ways to make the economics line up such that we can deliver as an industry without prices having to go back up 20%. I think, again, I don't see prices rebounding quickly. I see them rebounding gradually. But that doesn't mean that, we're going to be in this standoff, because I think some of those input costs are going to start coming into line, and margin will again return. I think the lead of a Vaughan and other municipalities, Mississauga, I think is another one, I think is the right frame of thinking by municipalities. Will they all do it? No. I mean, Markham already came out and said that they're not doing it. They all have their own budgets. They have their own constraints. They have their own funding requirements and things like that. So I don't think we can rely on it. I think in our areas of focus for high rise, we just have to continue to, the fundamentals haven't changed, so we're going to continue to invest in them. And I think we're going to see different ways for us to make up that gap.
On the cost stack. And I sort of think about a recent deal we did on the high rise and the way we acquire land, through sort of unique assemblies and such is another sort of way we can approach the cost stack to say, let's look at the input side from the very beginning.
Yeah, I mean, look, that should be a windfall. So if you go back to the first thing we talked about, in where we're focusing, and one of the areas of focus is having the type of acquisition and the price we're paying. If we've got that right, and things make sense in this haywire world where revenues are down and costs are up and things like that, and they still make sense, that gives you a ton of flexibility. So the key theme to everything we've been doing in the last year, for sure, on the new acquisition side is about we're buying flexibility. Whether it's that type of deal where we're buying at a cost base that makes sense, and if we're right, it should be a windfall.
Sure.
Right? We should be able to see more margin as we go if prices rebound or if costs come down or some combination of the two. But if nothing happened, it still made a lot of sense. We're doing the same on the low-rise side. So I think that's where we're kind of sharpening our focus.
Yeah, and so I want to talk about the low-rise segment a bit as well, because one of the things we touched on in a previous episode was this legislative sort of change coming in with the provincial policy statement of 2024. One of the material changes in that statement being the way that private applicants can now look at lands inside and outside of the urban boundary, right? In the past, you're a landowner, you're at the mercy of the municipality. Your municipality shuffles the chessboard around. If you're not included, you got to wait potentially 10 years. Now, with the PPS 24 coming into play, private applicants can sort of put their lands forward for inclusion in the urban boundary, develop their lands. So from that perspective, does that now tell Greybrook, hey, we need to adapt in how we view these lands, whereas in the past they may have been too uncertain. Now we can actually go after them, and you know, as a deal we're working on right now actually falls into that category.
Yeah. Well, the one we're working on now is a good example where I would say that a number of years ago, even last year, I don't know that we would have acquired something like that, because, as you mentioned, private applications are now welcome, and that's something that developers have more control over. I think almost more importantly than that is appeal pathways for decisions that are made around municipal boundary expansions and settlement area boundary expansions. Historically, when cities undertake those type of reviews, they do so in 5 and 10 year increments, sometimes 5 years, sometimes 10. It's not a codified sort of time frame. I think every 10 years is required, but anything in between that, it could happen or not. I do think, though, that those processes were often, taking into account what's required from a development perspective, but they were also very political in how they were done. And developers, once decisions were made by the municipality and ratified by the province, the developers had no ability to appeal decisions. So in the rest of most of what we do in development, there's appeal rights, and that's how you're confident, notwithstanding there's always politics, there's always, the tug of war with approvals. But that if you have a technically strong application, even if the planning staff or the councillor don't support it based on whatever their reasons are, sometimes they're political and they have nothing to do with the housing requirements, it doesn't matter much, because you can appeal them and you are aligning yourself with the provincial framework and what municipalities need. So we've always been comfortable doing that. That's what we do in our day-to-day business. That was not available to us previously with these sort of municipal comprehensive reviews. Now that there are appeal pathways, that makes it much more akin to what we would do in the normal course of development. So it kind of makes those types of lands much more of a risk-reward proposition we're willing to take, because you can buy land that it sits outside of settlement areas, for a fraction of the price of what it costs within these settlement areas. And now that we can study the lands that fall outside on their technical merits, make sure that they conform with everything that's required and stated by the municipality and the province. And if we move forward with those lands and there's some sort of reason they're not included, and usually it's politically driven, we can just stick to the technical merits, and we feel confident that we can get those lands to where they need to go. So I think it's opened up a really, really interesting avenue for us to be able to create value, because if you look at some of our historical projects that have generated probably the most outsized returns, are the ones over a long period of time where we've got to benefit from the land development value creation in addition to just the buy, sell, deliver. And these are probably the best test or the best use case of that.
Sure.
It's just before we weren't comfortable with the risk, and now we're a lot more comfortable.
Yeah, no, I think it's a material change, and looking at the deal that we're working on right now just shows you the sort of upside potential. I make the joke of turning a turnip farm into a beautiful community, right? If you're valuing land at that agricultural value and you take it through the whole cycle, there's these key material stages where you're unlocking tremendous value in the dirt. So I think the rest of 2025 is going to be a really interesting year. We'll see how the market plays out. Sasha, really appreciate your time today.
Thank you.
Thank you.